Welcome to lecture 9 of the day trading model. This lecture is going to be about live executions. Before we begin with this lecture, I must first give you a risk disclaimer. The ones that know is solely a platform where content gets shared for the purpose of educational and or entertainment purposes only. TOTK is by no means a financial advisor, meaning everything that I will share during this lecture and have been sharing during the past lectures is all meant for entertainment or educational purposes only. If you want to read the full risk disclaimer and the terms of service that you have agreed upon when joining the mentorship or the ones that know, you can do so on theonesthatknow.com. The table of contents for this lecture is as follows. Execution breakdowns. Meaning, during this lecture, we're going to discuss only executions. Meaning, I'm going to showcase to you that the logic that I've been sharing with you can be applied live. I'm not telling that you should apply it live, again, because I'm not a financial advisor. However, I'm going to showcase what I have done in the past, and it's important to note that these past events are not indicative for future results. Secondly, what I find important to note is the fact that what you're about to see is not normal, meaning you're going to see trades that were all taken in 1 week time. And this is going to be a very long presentation because there are a lot of trades to break down. And the thing that I feel like is very important to share is that it's important for you to have realistic expectations. If you're completely new, if you've just started learning about trading, please don't think that this is what trading should be like. Capturing every single move, capturing every single session a trade, or anything like that. Because it's not. That's not the goal of trading. Don't look at me, at someone who has been doing this and applying these concepts for a rather long time, and think that you should do the same, because you shouldn't. One trade a week, one very good setup that generates you, let's say, $3,000, $4,000, $5,000. Isn't that enough for a week? Why try to push it? Why try to push it beyond that boundary of just one good setup, or at max 2 good setups, if you're completely new? The reason why I wanted to share that is because the amount of trades that have been taken the past week or during the week of this lecture is high. There were many trades, and that was the case because the markets were delivering exactly like I wanted them to deliver from the logic that I've been teaching you. And whenever that is the case, I can lock in and focus, meaning no distractions around me, just me and the charts doing the work. This will be a very good showcase that everything that I've been teaching you when it comes to time and price sequences or time and price cycles is occurring week in, week out. So enough of the rumble, I should say. Let's begin with today's lecture. Let's buckle up because you don't want to miss this one. So first of all, we're going to take a look at the Monday delivery. What we can see is that on the left side we have Nasdaq, and on the right side we have ES. We can see that the Kraken correlation was present on the lows. Nasdaq made lower lows, whilst ES made higher lows. This was significant because we purged sell-side liquidity. The time of day was right for the market to potentially turn around. Plus, the markets were below the midnight opening price right here. So therefore, in a consolidating market, we can anticipate the market to draw back towards the midnight opening price or in close proximity to it. S&P confirmed that this was likely to occur. If we zoom in on the 1 minute time frame, we can see the following. We can see that again a cracking correlation was present on the lows right here during the lunch cycle. Nasdaq made higher lows, whilst ES made lower lows. Notice during what time this cracking correlation is occurring. 12:45 to 1:15. You might be wondering, how is that cracking correlation occurring between 12:45 to 1:15 if the low that is being annotated as the crucial low right here formed before that? It's because we're paying attention to this low right here. What we then see on the lower time frames is a beautiful buy program after the S&P was confirmed. Market displaces to the upside, trading above this upclose candle, which is a bullish breaker. Why is it a bullish breaker? Well, we have a low that forms here, a high, lower low, higher high. So now we want to see that upclose candle function as support on price. The gap that formed right here was a breakaway gap. Why was it a breakaway gap? Because price should never trade that low into the breaker anymore if it's going to be very bullish for a run higher. I personally did not enter here just yet. I waited for the next BC to form. This BC right here. Institutional order flow entry drill took place when the market tapped into the BC multiple times and then immediately rejected it. This trade was executed live with a voiceover, meaning I basically recorded the execution and I did a voiceover whilst I was in the execution, meaning I was just sharing what I was thinking, just to share with you sort of the way that I analyze trades whilst I'm in them and manage those positions. The drawing liquidity was this buy side liquidity here. You might be wondering, what are all these gray boxes on your chart, Zeus? What are they representing? Well, during this lecture you will see that I'm making use of these gray boxes to represent the 90-minute cycles. I want you to investigate and pay attention to the lows and highs of these gray boxes, because that is what is the focus of today's lecture. I'm going to share with you how I'm utilizing these cycles to do some magic. Let's keep it at that. So we see that the high of the 11:30 to 1 p.m. time cycle is right here. This is the lunch cycle's high. During the 1 to 2:30 cycle, we refer to this high. It's a very important reference point. And when there are signs present that the market is going to draw towards that high, so we had SMT right here, showed that the time was right for the market to draw to that buy side liquidity, and therefore any single discount array or any single retracement is a potential buy opportunity. I then trailed my stop and basically got taken out prematurely here. The market ran up higher, and then I took another trade. The trade that I took was the following. Remember that breakaway gap that I mentioned prior? Well, I said this before within the mentorship, but a breakaway gap turns into a draw on liquidity when order flow changes, meaning when the tide shifts from buy program to sell program. Meaning, if we are recognizing that the order flow has changed or shifted, we can target that breakaway gap as a potential draw on liquidity for a sell program in this case. So when the 2:30 to 4 p.m. 90-minute cycle began, my eye was immediately drawn to this high right here. which was the high of 1 to 2:30 p.m. Before I break down this trade, let me just show you the execution video just to know that this was in fact taken live. I've already said before, but there are so many people out there that are hindsight warriors that only can seem to make their logic that they're teaching work in hindsight. You never see them apply it live, and I'm doing the complete opposite, and that's how I'm going to shock this industry. Alright, so you've just seen the execution video. Let me dive into the breakdown. So during that third PM cycle, my eye was immediately drawn to the high of the second PM cycle, the high being up here. And what I want you to study is how the market took out this buy side liquidity, meaning the buy side liquidity engineered above this high during that third 90-minute cycle, and then reverted lower, drawing towards sell side liquidity. Beautiful sell program and a nice sweet run. What we can see is that there was a cracking correlation at the highs between ES and Nasdaq, or Nasdaq and ES, I should say, because Nasdaq is on the left, ES is on the right. Nasdaq created higher highs, whilst ES created lower highs. That is SMT. So I want you to think about the following. There was SMT present on the lows here that began this buy program during the PM session, and there was SMT on the highs that began the sell program of the PM session. Random, right? If we take a look at the annotated chart, we can see the following. We can see that the buy side liquidity above this high was taken out, SMT with ES took place, and at 2:55 p.m., which is an important time, the market formed a high and it then began to sell off. Now what I want you to investigate is how the discount arrays on the left side of the curve were getting violated and how they were getting utilized as resistance on price once broken. This is how you measure true order flow. the moment that price reaches a potential turning point, a point of interest, so to say, our eye is immediately drawn to whether or not the left side of the curve is going to continue to function as support to send price higher, or whether or not it's going to get violated. And if it will get violated, we want to see that the left side of the curve act as resistance on price. As you probably already saw within the execution video, I did not enter up here. I could, however, I was not actively behind the charts. I was not monitoring the live price action. However, when I came to the charts and I saw that we already began the sell program and we began displacing lower and the market traded below specifically this up-close candle right here, might be wondering, why are you referring to an up-close candle if you're bearish? We'll get to that. When I saw that, I went short inside the retracement into that, with the old breakaway gap being the drawn liquidity. When the market failed to displace through that breakaway gap, I eventually took out the position because I knew that the retracement was then likely to occur next. And I was eventually targeting this sell-side liquidity right here below the first PM cycle's low. However, when order flow showed to me that that was not likely to deliver within this run, meaning the run from this level to this level, it was obvious to me to get out. And that's how you listen to order flow, because look what happens next. The market retraces all the way above entry into the CB, and it then distributes lower during the final 10 minutes of the day. This was again a valid short setup, targeting this sell-side liquidity. So what we saw was a market make a buy model towards the PM cycle 1's high during the second PM cycle, and then the third 90-minute cycle set up a market maker sell model into this original consolidation down here. And now let's take a look at this up-close candle. Why is that important? Well, if we fractalize our cycles and we divide 90 minutes into 3, we get 30, meaning we have 30-minute intervals. Now, during the current 30-minute interval, we are referring to the previous 30-minute interval, meaning in order for continuation to take place after trading below the previous 30-minute cycle's low, we need to see that low function as resistance on price. And that's what you can see right here. Between 3 to 3:30 p.m., the market traded below the low of 2:30 to 3 p.m. Market retraces into that low. Boom, that's a short. Nice run. Here we are on the next chart. We are now on the Tuesday. What we can see is that on Tuesday, the market opened up from the midnight opening price and immediately ran up higher. What does that mean? It means that a lot of sell-side liquidity got engineered below every single low that formed, because everyone that has a retail-minded perspective about the markets wants to chase a market that is so bullish, so to say. So when they see the market just go higher from the open, it's immediately a buy to them. We of course know that the market only draws to liquidity and or inefficiencies, and therefore we know that the most liquidity was on the sell side, since everyone was so bullish. So when the market displaced below this down close candle right here with a CB, and I saw the market retrace into that during the right time, I went short during the morning session, targeting this sell side liquidity, and I was also targeting the midnight opening price. However, price just fell short of it, and it eventually delivered during PM, which I also executed in. So let us now jump into the lower time frames. Here we can see the morning session's delivery. And before I break down this delivery, I want you to pause this lecture, I want you to pause the recording, and I want you to investigate what you see with your current level understanding of time and price inside of this delivery. Pay attention to details, because there's a lot of information present that is very valuable. Please pause the video, don't waste this opportunity to learn. I'm going to give you 3 more seconds. Telling you, some of you never pause the video, you just want me to spoon feed you. That's not how this mentorship works. Because you don't learn from someone that spoon feeds you. You need to think for yourself, and eventually the light bulb moments will go off. So let us first take a look at time. Time in the form of our 90-minute cycles. Meaning we immediately should be drawn towards 8:30 and 10 and 11:30. These are of course not the beginning cycles of the morning session, they are the second and third cycle of the morning session, as we know. However, on this delivery we can see that 8:30 is important, 10 a.m. is important, and 11:30 is also important. If we would just put a vertical line at 8:30, we would get this candle right here being the open of the 8:30 to 10 a.m. 90-minute cycle, and it is also therefore the high of that cycle. I want you to put a line here in your thoughts and see how price traded above there after 10 a.m., taking out the buy side liquidity above this wick, forming a high, retracing lower. Why is this no displacement yet? We'll get to that in a bit. retracing higher. I should say expanding higher, my bad. High forms, sell program begins, boom, there it goes. Important reference point inside that whole delivery was this high. If we take a look at intermarket relationship, we can see the following. We can see that Nasdaq, of course, made higher highs relative to that previous cycle's high right here, whilst ES made lower highs. So that means we are seeing SMT, a cracking correlation, take place between two previous cycles highs. And what we can also see is that above that previous cycle high on Nasdaq, another SMT took place. SMT with ES, showcased by the black lines. Nasdaq made lower highs, whilst ES made higher highs. And you might be wondering now, okay, but Zeus, how do you know that this is not a real displacement leg yet, that the market will first seek to trade higher again before really beginning to roll over? It's due to this. No significant SMT was present yet right here that confirmed that the smart money reversal was in to then distribute lower. If we take a look at the breakdown on the Nasdaq chart, we can see the following. We can see that at 10:04 a high formed on Nasdaq, and at 10:18 right here another high formed, and this was the high that the SMT got created with ES. Market displaced the lower, trading below this down close candle. CB formed inside the displacement leg. Market retraces into that IOFED institutional order flow entry drill. I personally missed that one. It went too quick for me. So what I did was I waited for an immediate rebound to take place, meaning the market traded lower aggressively here and then opened up, repriced higher into the low of this candle that traded into that CB. Immediate rebalance, went short there. Stop was above this candle's high, should never be broken. Boom, market distributed lower towards the sell side liquidity below the previous cycle's low. Now notice where the 9:30 opening was as well. The 9:30 opening was around this area. Notice that for the whole morning session the market was trading above that 9:30 opening price, meaning market was creating the narrative, or the idea I should say, that it was gonna deliver higher. So every retail minded trader would look at that and think, well, okay, we're bullish for the day. We've been bullish so long, let's look to buy. We place our stop below any specific low that formed. There we go. Of course, we know that the market draws towards that liquidity, so we just had to wait for the right time and the right confirmations to be present to confirm a sell program into that sell side liquidity. What I want you to investigate on yourself is the 15-second time frame right here. That was my execution time frame on my other screen. I use the 1-minute chart for the immediate rebalance. However, on the 15-second chart, you will see a pattern that is very familiar to you. Once the market traded below the sell side liquidity, below this low, it retraced into this CB. This CB was a very important reference point, and when this high formed right here, it had to distribute lower aggressively into the midnight opening price if it was going to deliver. However, what do we see? The market consolidates, and when it failed to displace lower, I knew that a potential change in state of delivery for the short term was present, and especially when the market traded above this high. Crucial high, market traded above it, I went out and look at the market retracing all the way into entry, into this opco scanner right here, before eventually going lower during the PM session. This is how I manage positions. Now study the time as well of this candle. Why specific that candle, you might be wondering. Look at the time right here that's being showcased by that indicator. Time-based partials in combination with price patterns, or price cycles, I should say. We're now going to take a look at something that I've introduced recently during the previous lectures of the model series. And that is an advanced way of looking at dealing ranges. Do you notice that the reversal took place in close proximity to the 18,600 price level? If you have watched the ranges lecture, you should know why this level is important. A high forms in close proximity to that area, and you might be wondering, well, how could that be useful? Well, the moment that price reaches that level, your eye should be drawn to whether or not the signs are being present that you are looking for. These signs that I've been teaching you to confirm that a high or low within a smart money reversal is in. Where does the market draw towards? To what price level? What is a crucial price level within any particular range where there's a high and low established? Equilibrium. Where is equilibrium? At 18,550. Why did I trail my stop the way that I did? Why did I manage the position the way that I managed it? Because during a very specific time window, the market displaced above equilibrium, and that would have not occurred if the market was gonna rip lower towards the opposite side of the range. We're now going to take a look at Tuesday's PM session. What we can see is that on Monday there was this BC that got created. The market repriced into that BC, but it only tapped into the higher part of it. This means that there's still an imbalance that has yet to be balanced out within the delivery of price. Therefore, we can anticipate the sell side liquidity inside of that BC to get ran, especially when the market failed to continue higher. The order flow was bearish because the market displaced below this BC right here, and notice how the market is finding resistance inside of that price range. The market was just waiting for the right time, and then it eventually distributed lower aggressively, as you can see. If we zoom in, we can see that inside of this fractal, on these highs, there was a Kraken correlation between Nasdaq and ES. Nasdaq created higher highs, whilst ES created lower highs at our point of interest. This point of interest will be more obvious on the lower time frames. But before we dive into the lower time frames, I'm just going to ask you the following. I want you to take a look at this delivery. We're now on a 5-minute chart. This is something different than a 1-minute chart. And I want you to study how the market ran up higher during the first PM cycle. The market was trading lower and eventually went sideways. Then the second PM cycle came along and the market repriced higher. This repricing higher has one function, and that is to engineer sell side liquidity. The market then opened up at 2:30 for the third PM cycle, traded higher, manipulated, taking out the buy side liquidity of the previous cycle's high, forming a high, and then reversing to distribute lower. This was a perfect manipulation scenario playing out. If we zoom into the 1 minute time frame, we can see the following. From 1 p.m., the market opened up and it basically went sideways for a bit. And then towards the second half of that second PM cycle, the market began to expand higher. That expansion has one function, and that is to engineer sell-side liquidity. Because every retail-minded trader will look at that expansion higher, and they will think this is going to fly, this is going to continue, it's going to reverse during the PM session, relative to the AM session that was so violent to the downside. The reason why they're thinking this is because retail-minded traders are always trying to capture bottoms. And we of course know that when the order flow is bearish on the higher time frames, that does not work. So when the market then opened up at 2:30 and it ran up higher, trading above the previous cycle's high at exactly 2:37 p.m. and then a high formed, followed by displacement lower, the sell program was confirmed, especially because there was SMT on the highs here with ES. Market traded lower, retraced all the way into this bearish breaker and into this CB. Now notice that there were people that were trying to capture this long right here. They thought, bullish breaker, with an imbalance, we will long this. No, why not? Because it's a false breaker. Meaning that breaker is not a real breaker since it is not within a market maker buy model. We're in a market maker sell model with our original consolidation being here. Higher time frame order flow is bearish, so therefore we can anticipate this breaker to get violated. Market expanded away from that bearish breaker. CB got created, market retraced into that IOFET, institutional order flow entry drill, meaning the market taps into that CB right here, and it then immediately rejects it. New CB gets created, market retraces into that. This is where I went short inside of this CB, stop above this high, and the market expanded lower aggressively. This gap is a breakaway gap. The reason why this gap is a breakaway gap is because it formed after we traded away from this imbalance already. And secondly, because there was a rush for the market to deliver lower aggressively during this time window. Now notice that the cleanest run inside of this whole delivery originated between 2:45 to 3:15 p.m. That's our final PM macro, the time period we're interested in. Market expands towards the sell side liquidity below this low and below this low, and it eventually draws even lower. Now notice that the previous cycle's low, which was this candle right here, acted as perfect resistance on price once broken. This occurred because there was a CB that broke through it. This is when true support to resistance IDs work. It's when this CB breaks through the low, but also when the order flow is drawn to a very specific price level below current market price. Nice low resistance liquidity run, sweet trade.
Shawty poppin' money for a soul, yeah. I never want nobody sober. Up all night till it's over. Over. Shawty poppin' money for a soul, yeah. I never want nobody sober. Up all night till it's over. Be there for her till she's so bad. Shawty need a pop and molly for her soul, yeah. She want dope, yeah. Need a flow, yeah. I just wanna fuck her till she got it so bad. Well, you're from the side, here's some doggy, yeah, you knew. I know that you love it, how I like it when you moan. I just need some time, but she ready for round two. Yeah, baby, I do, yeah, I do, till it's over. Shawty poppin' money for a soul, yeah. I never want nobody sober. Up all night till it's over. Over. Shawty poppin' money for put it on me. Up all night, going all in. She want my heart, but I never could accept that. Mess around with you was like a death trap. It ain't what I thought, we was getting lost. Now I make plays at the red blacks. You a bad habit, I'm a dead dad. Oh, you love me, you should've never said that. Focus on the coin, yes, you wanna join. I'm just trying to figure where your head at. I know where you wanna go. Don't lie, I can see the signs. When the smoke clears and the night is done, will you call me? Will you call me up? Over, shawty poppin' Molly for so yeah. I never want nobody sober. Up all night till it's over. Over, shawty poppin' Molly for so yeah. I never want nobody sober. Up all night till it's over.
I left the crib with my Giuseppe's on. The spotlight is on. That bitch took it to prom. Christina Milian. Dope is hella strong. Clip is hella long. My labeled at the top. BFR is on. Get the firearm. Turn him demi on. She jumped from pat to pat. She a little frog. Back to back. John to John. She a little bitch. Something I never saw.
Over, shawty poppin' Molly for so yeah. I never want nobody sober. Up all night till it's over. Over, shawty poppin' Molly for so yeah. I never want nobody sober. Up all night till it's over.
The trade we're now going to take a look at occurred during Wednesday's PM session. During Wednesday's AM session, we saw this very large expansion leg lower. That immediately showcased to me that I should focus on the PM session. I was looking for a retracement into this CB to then continue lower. As you can see, I've written you can be wrong with your draw on liquidity and still make money. The reason why this is the case is because I went short inside of this red box, this red area. But you see that the most movement during the PM session was on the upside. And I'm going to showcase to you how I managed this position and how I basically justified going short and then recognized that order flow was changing. I missed out on the longs and the longs were rather clean, as you will see in a bit. So here we are on the 5-minute time frame, and as you can see I have the 90-minute cycles showcased again with the gray boxes. What you can see is that during the third 90-minute cycle the market dropped lower, meaning this down close candle right here is the open at 2:30. The market dropped lower and it repriced lower, targeting the low of the second PM cycle. This sells at liquidity. Why? Well, during the second cycle, during the second PM cycle, I should say, the market ran up higher, trading above the lunch cycle's high already. So therefore, there was no reason for the market to trade above this high anymore, since it already traded into that H1 CB. Therefore, when the market showed signs of displacing and the sell program initiating, I was anticipating the market to draw towards this sell side liquidity and maybe even towards the sell side liquidity below this low. However, there was SMT lower during the AM session between ES and Nasdaq, and that was the reason why that eventually did not occur. However, you can see that the market still dropped towards this sell side liquidity, which offered a nice trade. And from there on, during the final hour of the day, a buy program began to send it higher. If we zoom into the lower time frames, we can see that an SMT was present between Nasdaq and ES on the highs inside of that hourly CB above the lunch cycle's high. Here we are zoomed in onto the 1 minute time frame, and we have established that SMT is present right there. At exactly 2:30 p.m., the sell program began and the market began expanding to the downside. I was personally looking specifically for this BC to get violated, since there were no real BCs on the 1 minute time frame inside of this leg higher. So my eye was drawn to this BC and secondly to something else, and that was specifically equilibrium of the previous cycle's range from this low to that high, very important reference point during the current cycle. Market displaced below that BC and I now wanted to see it act as an inversion for value gap on price. Time distortion takes place, market goes sideways and eventually displaces lower. It trades below this low right here and it then retraces into internal range liquidity, meaning the range was from this low to that high. External range liquidity got taken out, so the market has to retrace into internal range liquidity again to then draw towards further external range liquidity. If you understand that right there, then you are very far when it comes to your understanding of algorithmic price delivery and how the market moves and swings. Now notice that the market retraces during our final macro of the day, forms a high precisely in its CB and it then aggressively reprices lower, trading below the sell side liquidity here. Market retraces again into this CB and into this candle right here, to this big down close candle, or this up close candle, depends which one you want to refer to, both are important. And the market forms a high and it reprices lower once more. Now something very important happens, and that's the following. The market should have never traded above this high if it was going to run lower towards the sell side liquidity pools I had showcased. However, what occurred was that the market did trade above that high, so that signaled that a potential change in the state of delivery was present. And what you can see is that a BC formed inside of that trading above that high in here and a beautiful buy program began. Market retraced into that BC, formed a low, expanded higher, retraces into a new BC, expands higher, retrace, BC, expand higher. Beautiful buy program. Unfortunately, I missed out on this, but you know what? A new one will come exactly like this very soon. Now, you might be wondering, why shouldn't the markets have traded above this high if it was going to be bearish? Well, this high right here formed inside this CB, and that high set up a run into external range liquidity. It set up this run lower. So when it is the case, you never want to see that high get violated again if the market is going to distribute lower aggressively. Time-wise, the time for the market to distribute lower was also over. In fact, the chances of it reversing were higher, and that's why I managed the position the way that I did. The final trade that we're going to break down was a long during the PM session on Thursday. As you can see, on Thursday the market was basically stuck and trading the majority of the day between the BC that formed on Wednesday during the afternoon session. The BC being annotated or showcased by the two big blue lines. The long that I took was inside of this upgo scanner right here, and I exited around this price level right here. Might seem very messy on this time frame, and Thursday was very messy. However, if we take a look on the lower time frames in a bit, you will see a very sweet run during a specific time window where we want to see those type of runs. First of all, I want you to take a look at this delivery, and I just want you to take a minute and really try to dissect this delivery. I've zoomed it out a lot, and you can probably already take a guess why I have zoomed it out. And that is simply because I want you to take a look at where the lows and highs formed. So please pause the video, please pause the lecture. This is the final breakdown, so you already know that I try to hide as much as possible all the way to the end usually, to not give the people that are lazy an opportunity to get access to the type of knowledge that I possess and I'm about to share with you. This shall be fun. So what I've done is I've annotated the current range, the range that I utilized earlier this week as well to go short during the morning session. Of course, the prices were a bit different then, but the logic was exactly the same. Range high 18,500, equilibrium 18,450, and the low of the range was 18,400. Now notice that the market never displaced below 18,450, which was equilibrium of that current range. And therefore, what could be anticipated is the following. When the market begins to show signs of reversing around that equilibrium price level, it's obvious that it will not continue lower. Why not? Because it's showcasing to us that it's going to trade back into a premium of that range. So when time and price are aligning, when that's occurring, we know, okay, price is likely to draw back to the opposite side of the range. Meaning the market was going lower, made it seem like we're gonna go to the low of the range. However, we failed to displace below equilibrium, which is the most important reference point within every single particular range besides the high and low. So therefore we could anticipate it to drop back to the high. When I saw this low right here form above the previous cycle's low, above the low that formed between 1 to 2:30 p.m., it was obvious to me that they were likely to draw it higher again into a premium of that current range of the PM session. And that range was from this high all the way to this low. You can see that there was a CB left open. Exactly what price level? Around 18,500. This CB was already traded into. Highest high inside that CB is a buy side liquidity pool that's important. That's a reference point. That was where I had my area annotated as a first partial, or I was looking specifically how they would treat that high, I should say, and then I partialed inside of this CB inside of that area. If we zoom in now, I have annotated the following. I have annotated the full range from 18,500 to 18,400. I've applied quadrants, meaning I have applied the 25%, 50%, 75% of that current range. And what I want you to investigate is specifically 25% of that range. This was the annotation, or these were the annotations on my chart when I was executing the trade. And some of you might be wondering, why didn't you go long inside of this BC Zeus? Why did you specifically wait for that second BC? The answer is here on your chart. Because the whole delivery was so choppy yet, I'd rather wait for confirmation of displacement occurring through equilibrium. Yeah, we're gonna go deep here. Some of you are probably gonna go like, this is probably too much. And in all honesty, if you're completely new, if you haven't been seeing the things yet that I've been showcasing to you, then you shouldn't watch this part. But what we saw was that displacement through equilibrium of the range from 18,500 to 18,450 took place. So to 25% of that whole range from 18,500 to 18,400. So what I've done is I've basically divided this price range into two parts again. So when I saw displacement through that price level with ABC, it was obvious to me that I could just go long here, market long, stop below this low, and the market was likely to draw towards the range high. All occurring during the right time. A time during which the market should expand if this is the low of that current cycle that we're in. Market expanded aggressively higher towards the buy side liquidity above this high, traded above this CB right here, and then eventually failed to continue higher. So utilizing that CB as an inversion value upon price. So when I saw that, I knew I wanted to get out because there are two things occurring here. Market did not use this CB as an inversion value gap, and secondly, it didn't use the 18,500 price level as a new range low, as it should have if it was gonna continue higher. Market then fell lower. I went out of my position for a nice profit, and the market then went sideways before eventually chopping around and doing some crazy volatility towards the end of the day. If we zoom in closer to this delivery, we can see the following. We can see that after the market displaced above 25% of that overall range, or 50% of this smaller range from the range high to equilibrium, we saw this BC form, and that was just a perfect sign of, okay, now it's gonna run. There were some questions about the following. Why wasn't this leg in here the leg where the continuation occurred? Why did the market have to wait until that final 90-minute cycle? And that's a valid question. It's a very good question, in fact. And I have annotated something on this chart that I didn't have on this previous chart. I want to give you a second to try and look what I'm referring to. But it all has to do with the left side of the curve influencing the right side of the curve. Because I've just showcased to you the importance of very specific price levels and how the displacement through those levels is very important to determine higher time frame, or I shouldn't say higher time frame institutional order flow, but more so microcycle institutional order flow, meaning during the current price cycle, how price is delivering during that current price cycle within a time cycle being from 2:45 to 3:15 p.m. However, when you are looking at it from a market maker model perspective, you can look at the left side of the curve, and there's one thing that should immediately pop out to you, and those are these two CBs. Notice that during this so-called displacement leg higher, with these imbalances here, the market did not displace above these CBs here. However, when you take a look at this displacement, you can see the displacement above those CBs occurs. So you have it. I know it may sound so tricky and it may sound so weird, and you're probably not seeing it at all just yet, but you need to cut through all of this noise. This delivery is all just noise. It's about these two CBs and it's about this BC. Those are the two most important reference points that set up that whole run higher, besides, of course, the price logic that I just described to you. It's about how the left side of the curve is influencing the right side of the curve. I think that some of you are probably like, whoa, what did you just share? And that's completely logical. This is something I've never discussed before anywhere, this type of logic. However, when you are able to utilize it, when you're able to see it, it is crazy. It's absolutely insane. So that's my deep desire for you. I want you to investigate this. I want you to be able to see it for yourself and to see it repeat. Because once you see that repeat, there's no question anymore about why this stuff works. It's simply because this is the way it's programmed to work. It's not because a buyer or seller steps in at that price level. It's because this is how price is being delivered from a higher level. So I want to thank you for watching this model series lecture. It was a very long one. I hope you were able to enjoy this type of breakdown lecture. And I'm of the opinion that the following lecture should be exactly the same when it comes to breaking down the trades. Next week we have NFP, so I can't promise that I will be having a lot of trade executions. If that's not the case, we will discuss a different topic. However, if I do have some executions to break down, I want to break them down during the next model series lecture, because I'm of the opinion that once you understand theory, once you understand what you're looking for, all it is about application, seeing it again and again and again and again, over and over again. And when you see that occur, boom, light bulb moments take place, and you begin to accept this new reality that you're becoming a part of. So again, thank you for watching this lecture. I hope that you took proper notes. If you did not yet, please watch it back and take the proper notes. I want to wish you a very nice day and be safe.